Welcome to Nasdaq Trade Talks, where we meet the top thought leaders and strategists in emerging technologies and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Andy Hyer, Client Portfolio Manager at Nasdaq Dorsey Wright, as well as Ian Saunders, Senior Analyst at Nasdaq Dorsey Wright. And we're here to discuss the asset allocation decisions that advisors are making in this market. It is great to have the both of you with us. Ian, let's kick it off with you before we get into how advisors are approaching the market. Tell us about the annual Catapult Conference, that's coming up. Who's the attend for? What's it all about? And what are attendees going to get out of it?
Yeah, absolutely. Thank you for having us on. The Catapult Conference is a refreshed conference that we're putting on from Nasdaq Dorsey Wright. It's going to be in Nashville, Tennessee, October 15th through 17th. We've been doing conferences for many years, and we've been doing some larger conferences for several years. The past couple of years, we've condensed two of our larger conferences down into this one event, and now we're coming through with this refresh for calling it Catapult. It's a nice new fun name for 2024. The event is going to be 3 days of kind of more in-depth presentation style, as well as a lot of networking and workshop opportunities. We're a technical research firm. We can get pretty in the weeds with our analysis, but the event is meant to kind of provide an overview of who we are and what we do and how to use the technical analysis to really make your practice more efficient. So it's geared toward financial advisors. Anyone's kind of welcome to come there, though. And one of the biggest benefits we've seen from the event and hearing from those advisors who have come in the past is, yes, you get a great opportunity to hear from us, hear about how to use the website, our research platform, hear about the current updates and technical things going on in the marketplace. But you also get to hear from other advisors, how they're using the tools, how they're using the platform. Everyone's going to use it in a little bit different ways, so it offers a lot of different flexibility and capabilities there for those 3 days. So we're really looking forward to it. We'll include the sign-up links and some of the communication there, but should be a great event.
All right. Appreciate you sharing that with us, Ian. Andy, let's talk about some of the major asset allocation decisions that advisors are making in this type of market now that volatility has crept back in a bit here.
Yeah, no, volatility has definitely come back. You know, from the conversations that I'm picking up with advisors, it seems like there are a couple major themes. One, just over the course of the last decade, people have become more and more concentrated in large cap growth. That's an area that has performed extremely well, has vastly outperformed other parts of the market. But every so often we get these corrections that makes people nervous. And, you know, people also wonder, how long is this going to go? The reality is none of us have a crystal ball to know exactly how long is large cap growth going to be the dominant style box. But diversification is evergreen. You know, finance 101, most advisors working with their clients, they want to have a diversified portfolio. And I think you know, that's a conversation that is coming up. How do they want to diversify away from large cap growth? Do they want to have strategies that are adaptive? And I think that's one thing that speaks well to the types of strategies that we run here at Nasdaq Dorsey Wright. Relative strength driving those portfolios, they tend to be very adaptive strategies, not constrained to a style box. As we see, you know, value come back in favor in certain areas, and certainly financials have improved more recently. That's a strategy that can adapt and can find that leadership. You know, another area that I think is on people's minds is over the last couple of years, you've seen a ton of money go into money market funds. You know, they've been able to just shorten the duration, really lower the volatility of their fixed income exposure, and, you know, collect 5%. And, you know, for a period of time, I think a lot of people looked at it and said, hey, this is a no-brainer. There's no downside to this. But, you know, as we move closer and closer to the time when the Fed is cutting interest rates, I think there's some opportunity costs, there's some reinvestment risk, and more people are having that conversation about, hey, do I want to add duration to my fixed income exposure? Do I want to invest in strategies that are more adaptive? And again, that's something that works well for what we do at Nasdaq Dorsey Wright with our tactical fixed income strategies. We have been able to add duration that's really benefited in recent weeks as we've seen interest rates start to drop, and so those are a couple of the key points that I see come up with advisors. They're trying to make these decisions with their clients. How do they want to tweak their asset allocations?
Yeah. And Ian, Andy had mentioned about the relative strength-based approach to investing is really popular with Nasdaq Dorsey Wright clients. How does this philosophy and approach different from other types of popular investment philosophies?
I think there's a few main ways. I mean, the main thing that we're looking to do is provide a systematic, objective view or lens into the market movement, right? And so we're able to take that lens or our aspect of relative strength and apply it to different kind of marketplaces, different areas in the market. So like Andy brought up some of the movement in the U.S. equity side. the kind of diversification away from large cap growth. We see a lot of that coming through on the sector perspective recently. So it allows the movement that we're seeing from some sectors that have previously been big winners, like technology, not doing as great recently. Some other sectors kind of showing a little bit more improvement recently, and it just provides a more objective lens into that movement. Certainly seeing some of the same movement on the fixed income space, but the relative strength picture specifically there for domestic equity for sectors, I think is one area that we're definitely keeping a really close eye on. We're seeing some rotation, some potential changes in leadership. And when you get at those rotation times, that's when you need an objective rules-based approach to really kind of tell you where to go, because that leadership might be changing moving forward.
Yeah. And Andy, I think it's also important to note out that about 40% of the industry uses separately managed accounts in their practice. Why do you think that is? And what's appealing about SMAs to both advisors and to their clients?
No, so separately managed accounts have been around for a long time, decades, but we've seen the usage of separately managed accounts continue to increase. And there are a couple of things. I think from an efficiency standpoint, for an advisor who's working with a client, who's constructing an asset allocation, may be doing estate planning, different types of services that they're providing for their clients. It's difficult to be all things to all people. So to wear all the different hats that a financial advisor wears, building their practice, working with financial advisors, doing the asset allocation, to also be doing all of the investment management, that's a difficult task. And so we see a lot of advisors who will want to outsource part of that service that they're providing their clients to third-party money managers like a Nasdaq Dorsey Wright and others, where we can come in with expertise in certain strategies in certain areas. And an advisor can work together to find best-of-class managers, construct an asset allocation. They still are an incredibly valuable part of the equation for their clients, but they're overseeing the broad asset allocation and pulling in these different third-party money managers that can really add value to specific parts of the asset allocation.
Yeah. Andy, it seems as if Nasdaq Dorsey Wright was pretty early to the game with this type of methodology. And as you approach 20 years of running the family of systematic relative strength portfolios, what can you discern from that? What are some of the key milestones? What are some of the key decisions that have helped advisors along the way over the course of nearly 2 decades?
No, this is a fun period of time for us, because in 2005 we embarked on this approach of a systematic relative strength approach to managing separately managed accounts, and we now are approaching this 20-year track record. And it's fun to look back and see, have they outperformed every year? Absolutely not. I mean, there have definitely been stretches where they have not, but the long-term performance has been really, really solid. And so we're proud of kind of where this stands. In the industry, there's so many managers that come and go. Every couple of years, there's a manager that's a hot dot for 3, 4, 5 years. When you get to 20 years, it's a different ball game. There's only so many managers that have been able to stand the test of time and really put up really solid performance over a long period of time. And there were a couple objectives as we went down this path. One, we wanted to come up with a rules-based methodology that it was systematic, that was repeatable, that was based on the extensive research on relative strength and momentum investing that Nasdaq Dorsey Wright is known for, and then just plug away. And I think, with our 2 senior portfolio managers, so John Lewis and Chuck Fuller, a lot of longevity here at the firm. So John's been here since 2002, Chuck since 2007. And it's fun to watch them operate and just see how they execute these strategies, in good markets and bad. There are good days, bad days, but over time, they've really stood the test of time. And I think that's, as an advisor who's building a big practice, what they're looking for. They're looking for something that they can be confident in, invest in, have confidence as they get in front of their clients, and feel good about the fact that this is a solution that's going to serve them very well over the next 5, 10, 15 years. One thing about this family of accounts is we've applied this methodology to a number of different areas. We've done it in U.S. mid and large cap stocks. We have an international equity portfolio that's done extremely well. We've applied it in small caps. We've applied it in developed international markets and emerging markets, in global ex-US strategies and multi-asset class strategies. So we've been able to take this underlying engine of relative strength and apply it in different ways, in a very rules-based way. So, we enjoy it. We're excited about where this is going. We're excited about what they've done. And, we love working with advisors to find solutions that will work well for them and for their clients.
Yeah, and Ian, I think it's an important distinction that John makes because it's important to recognize that markets, especially when it's so headline driven, sometimes it just doesn't always go from the bottom left to the top right of the chart, and that consistent management and, realistic average returns is important for a longer term objective.
Absolutely. It's not always about picking the name that's at the top of the news headlines, right? It's about picking the leadership and avoiding the laggards. When stuff starts to not do well, you got to move out of it and move into something else that is doing well. And a lot of times that might be harder to do, selling something you've owned for a while than jumping into new areas. So that's definitely something, that systematic approach is definitely something to keep top of mind when you're looking at these strategies.
Yeah, and certainly with John and Chuck on the show, we see that consistency throughout the years. Andy, Ian, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.